Banks survive because people believe their money is safe. The stock market functions because investors trust the rules. Even paper money only has value because we trust the system behind it. When billions of dollars are built on trust alone, and that trust instantly evaporates, the collapse is catastrophic. By early 2022, a cryptocurrency exchange called FTX had reached a staggering $32 billion valuation. The media and public largely accepted it as the undisputed future of finance. To the public, the company projected absolute, unshakable legitimacy. They bought Super Bowl commercials, sponsored Major League Baseball, and even slapped their logo across the Miami Heat's home arena. That external display of extreme wealth and cultural dominance successfully blinded both retail users and massive institutional investors. They looked at the branding and assumed the platform was completely secure. To understand how they bypassed standard investor skepticism, you have to look at the founder, Sam Bankman-Fried. He explicitly rejected the traditional Wall Street uniform, favoring cargo shorts, old t-shirts, and messy hair. He aggressively promoted a philosophy called effective altruism. He told the public his only goal was to accumulate as much wealth as possible so he could eventually donate it all to humanity. Curious, engaging tone. That highly unusual message worked. Instead of conducting rigorous financial audits, venture capital giants poured hundreds of millions of dollars into his vision. Celebrities followed suit. A-list icons like Tom Brady and Steph Curry appeared in national advertising campaigns, loaning their personal reputations to the company. The quirky persona and the philanthropic promises acted as the perfect disguise. The financial world bypassed its standard skepticism and replaced due diligence with emotional trust. Before he launched FTX, Bankman-Fried created a highly aggressive quantitative cryptocurrency trading firm called Alameda Research. This diagram illustrates the deception. Millions of customers deposited assets into a secure vault, trusting the platform. But investigations revealed a backdoor. Funds were continuously siphoned out to cover Alameda's trading debts. FTX secretly functioned like a corrupt bank, lending unbacked money. During the massive cryptocurrency bull market of 2021, asset prices kept climbing. New customer deposits flowed in fast enough to easily cover up the missing money, and the system appeared to work perfectly. Then, the 2022 market crash hit. Digital assets lost enormous value. Alameda's trades tanked, and they had to quietly drain even more cash from FTX customers just to stay afloat. By late 2022, FTX was operating with a massive, multi-billion-dollar deficit. Its entire survival relied on keeping that hole a secret from the world. The secret slipped out in November. A single financial report by CoinDesk revealed that Alameda's balance sheet was heavily propped up by a proprietary token invented by FTX itself. Changpeng Zhao, the CEO of rival exchange Binance, read the report. He immediately announced plans to liquidate his entire stash of that token, delivering a fatal blow to public confidence. The market panicked. In a matter of days, millions of users flooded the FTX platform, desperately clicking withdraw to try and pull their money out all at once. FTX had to freeze the system. They halted all withdrawals because the billions of dollars requested by customers simply weren't there. The second the illusion of safety shattered, a $32 billion empire plummeted into total bankruptcy in less than a week. The damage was absolute. Over 1 million customers lost access to their life savings. Thousands of employees were locked out of their jobs, and billions in wealth vanished. When bankruptcy investigators finally entered the headquarters, they found a complete lack of corporate controls. Multi-million-dollar decisions were being approved through disappearing chat messages, and billions of dollars were managed without basic financial software. The court appointed John J. Ray III to clean up the mess. He is the exact same restructuring expert who managed the Enron collapse. He publicly testified that the internal chaos at FTX was the worst case of corporate failure he had ever seen. Federal prosecutors stepped in. They charged Sam Bankman-Fried with massive systemic fraud, resulting in a high-profile conviction and a decades-long federal prison sentence. The media darling who spent years selling the world on his altruistic mission was finally unmasked in a courtroom as one of the most reckless financial criminals in modern history. The disaster permanently scarred the digital asset industry. Regulators cracked down, and surviving exchanges were forced to publicly prove they actually hold customer reserves. Investors adopted a strict new cultural rule: not your keys, not your coins. They stopped blindly trusting centralized platforms with their digital property. Every generation falls into a financial bubble, whether it's the dot-com boom, the housing crisis, or the cryptocurrency craze. People convince themselves that new technology has somehow erased the old risks. But regardless of how fast the algorithm is or how sophisticated the network claims to be, the basic laws of risk management and transparency remain exactly the same. FTX failed for the oldest reason in finance. It lied to its customers, and it lost their trust. History proves that once an institution loses that, no amount of capital or technology can save it. Money can be rebuilt. Trust is much harder to recover.